Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
So as we get into this, we're going to be hitting today the money multiplier method. This strategy that we have so dearly put all of our time and talents and efforts into learning ourselves, practicing ourselves so we can teach this to others. And this strategy really comes down to you guys. The wealthiest families in history have been doing this strategy for over 200 years. They've used it to eliminate their debt, minimize their risk and their taxation, and to leave a legacy for their families. And I'm going to show you guys how you can do exactly what these amazing people did yourself without taking on any more risk, without working any harder, without changing your cash flow, or without losing control of your finances. This presentation today is going to show you guys how you can become your own bank. But before we do that, you've all heard the expression, if it sounds too good to be true, it must be, right? Well, that's what I actually thought too when I first learned about the money multiplier method. How many of you guys here have ever wanted more money for just about anything at all in your life? If you say yes, which I'm sure all of you do, I do too, then you're in the right place. Today, I'm going to share with you guys a little known but powerful wealth strategy, a wealth strategy that will completely change your future if you implement and act on it. If you guys use these exact same techniques. How many of you guys at one point or another in your lives wanted more control or felt like you did not have full control over your money at any point? Maybe when you were 18, 16, maybe when you were in your 40s, maybe when you were in your 20s, maybe now. Awesome. Thank you guys for participating. Fern, what is up, my girl? Glad you're here. That's amazing. All of you are here. So wherever you're at on your financial journey, I welcome you. And I congratulate you for being here. Why? It's because there's so many people out there in this world that just talk. They claim they want to do well, but they're not here. The thing that you and I have in common today, guys, is that we are here. We're spending time together. And those of you listening, you know, me and you, we truly want to build wealth. And so great job for being here. And whenever I get into a presentation like this, I always am thinking, what am I going to get out of today's meeting? What am I going to learn? And I'm sure you're thinking the exact same thing. You don't want to waste time. I don't want to waste your time either. So I'm going to tell you right now how many things I have for you to learn today. And there are 4. These 4 things are protection. That is first. Because who doesn't want to protect what you earn, right? Obviously. The next is tax-free growth. Because don't you want to make smarter money moves, right? I'm going to talk about how you can leave a legacy. And, sorry, spoil it for you. I mixed the 2 words up. How you can get leverage, because there are tools you have in your life that you need to be leveraging more efficiently, and legacy, because we want to teach these things to those family members around us who should be learning these strategies as well. So I have a system that will help you guys accomplish all of these things. If you just could take these things home with you, a little blueprint from me to you, would that be worth your guys' time today? Give me a yes or a hands up or an emoji or exclamation point in the chat. I'm all over here today with my slides. I'm trying to manage a couple things right here. And so I'm mixing it up. So sorry if I keep going to different slides and coming back. Thanks for your patience. You guys are awesome. Yes, yes, yep, 100%. So I guess what would make a little bit of sense to start is for you guys to have a little bit of confidence in me, your speakers, you know who I am, and you know what I'm here to talk about. You have some confidence in this. So I kind of switched through this quickly, but this is my wife and I, Anna, and myself, Carson, Herleen. I have been with Chris Naugle for about 4 years. It's been amazing. But over the past years before that, I built a foundation for my young family to not just be rich, but to have and build generational wealth. And I can sum this experience up with 2 words: gratitude and choices. I'm so grateful that I get to just feel confident in my financial future. But more than that, I'm grateful for the opportunities that I've been given. I've had so many amazing mentors already in my life that have led me down the right direction to help me start this career and something amazing. And really, my story is simple. I've said it on here many times. I'm sure most of you can relate to it. But in my early years, I made a lot of mistakes. When I was young and dumb, I did stupid stuff, as we all do, right? But when I was 18, I actually went and served a church mission and I lived abroad. And it was amazing. Great experience of my life up to that point. Since then, obviously married. And by the way, I do have a child on the way. We are due in about a month. So T-minus 30 days. Got a baby boy coming in. So we're stoked. But these pictures will get more entertaining. We'll have more people joining these photos over the next few years, which we're excited about. But again, back to the story. After I went on that service trip, I came home and I was in school. And I had all these different outside influences pushing me different directions. I had, in one hand, I was really going down the traditional path. I was going down the finance programs I wanted to get into. I wanted to learn about money. I wanted to be in corporate America and kind of go down that world. But then on the other hand, I was around real estate investors. I was around entrepreneurs, business owners, and I saw the freedom and control that they had in their lives. And really, I had to pick which direction did I want to go down. And these 2 directions kept pulling me apart, and the tension got greater to the point where I had to decide. And so I made a decision to actually drop out of school and pursue an education in investing and learning how to make money work for me. And that decision changed everything for me, changed the course of my life. But above all, what's most important to me is family, as I'm sure most of you guys are too. And so what I want to talk about today is your guys' families and how you guys can get more money and more control over your money so you can spend more time with your families. So let's talk to start a little bit about statistics. You guys on this training right now are what I call the 5%. You're a part of the 5% because you are here. You're taking time out of your day to learn about money and better yourselves. Right now, if I was to go around and ask 100 18-year-olds and ask them, hey, if you guys were going to be do you think you're going to be wealthy and successful at age 65? Every single one of those 18-year-olds today would say, of course I would. No way I wouldn't be. But something happens between the age of 18 and 65 that changes everything, changes the whole dynamic. That I think, us today know that, but those 18-year-olds probably wouldn't have. What's actually crazy is the Social Security Administration came out and said that only 5 out of 100 people will be financially secure at retirement age. Think about that, guys. 5 out of 100. In the land of opportunity, the great country we live in, the place where you can do anything you want, right? All the dreams can come true. 5%. That means 95% of people are working until they're 65, 75, 85. Not because they want to, maybe taking on second or third jobs, but because they have to. Now, before you get discouraged and start worrying about your future, you guys are the 5%. I just told you. By wanting to improve yourself, wanting to get out of the rat race, wanting to have more control, just that desire starts a whole new wave of thinking that will propel you onto being a part of that 5%, whether you are already a part of it or you will be soon. And the biggest difference between you and them is your willingness to invest your time, your money, and your effort to learn something. So what are the things we're going to learn today, guys? Let's get into it. First, I'm going to start with a question. Why aren't more people successful? The mysteries of money. Well, there's some things in life that deter us. I've seen it time and time again. Here they are. There you go. Wealth killers that we have in today's world: taxes, inflation, and volatility. These three things are not, I shouldn't say lightly, they destroy your wealth. You guys go out and work hard, a tiny bit of money left over, you get taxed on, and then the dollar loses value because of inflation. And then there's volatility. All the money you save, you invest, and then there's volatility up and down and things change. There's no control or certainty. And then on top of that, imagine trying to fight that while trying to also be a part of the status quo, which we all do. And we're all going to do our own 401k because that's what we're told to do, not knowing whether it's good or not. I call it the hope and pray system. Hope and pray it works out. Then fear gets involved. How the market goes down, you pull some out, you're nervous, then it goes back up and you lose the growth. Then life happens. You got to pay for something. You got to take money out of your retirement for some reason. Maybe you lose a job. Things happen. So with all six of these factors going against us, it's very hard to build wealth in today's economy, especially in America. But it makes you think of this quote that I often hear from Mr. Will Rogers that we repeat often every single webinar we do, because you need to know and internalize this, that the problem in America isn't so much what people don't know. It's what people think they know. That just ain't so. A lot of what you've been taught about money may not actually be the truth. So I need you guys to keep an open mind, because in this webinar, I'm going to challenge the way you think about money. And to start, I want to start with a little bit of an example, a story. You guys all learned how to ride a bike when you were kids, I assume, right? When you were little. Once you could have figured out, I'm sure that you kept it going the rest of your life. Maybe you're not an avid biker, but you're sure you can get on a bike now and know how to ride it, right? It's muscle memory. When you guys have the handlebars, you turn right, the bike goes right, turn left, it goes left. Super simple, right? That's how a bike works. Well, there's this experiment done that's on YouTube. You actually can look it up. It's pretty cool. They tested if you could turn the handlebars. Well, if you could flip the handlebars around. If you turn the handlebars left, the car went, or the bike went right. Turn the handlebars right, the bike went left. Switching the brain around. Right? So it did this test. This guy got up on the handlebar, or got up on the bike, grabbed the handlebars, couple pedals, turn, fell. Okay. He thought, I know how to ride a bike. Let me just figure it out. Let me get the hang of it. Gets up, couple pedals, turns, falls. And he does that over and over and over again for hours on end. Could not figure it out. Eventually, all of a sudden, his mind switched. He could do it. Easy. Then he tried to go back to riding a bike the normal way afterwards. Couldn't do it. He did not know how to ride a bike just because his mind switched. Eventually, he did it over and over and over again and could do it again, right? But the point of the story is that when you learn something one way, it's so hard to change. The same is true for money. Since we were little, we've been trained how to think about money. What would happen if I told you guys that what you were taught, that the way of thinking about money, was not the best way for you to look at it? Would it be impossible to change your mindset and kind of come to this new realization of how money can be used? Probably. But eventually you would learn how to ride the bike backwards, just like this guy did. And earlier I mentioned to you guys that a lot of what you're going to think about this maybe is maybe it's too good to be true. And what do we really hear when we hear someone say it's too good to be true? Well, we probably ignore it. We walk away from it. We disregard it. Well, this 200-year-old strategy is too good, is not too good to be true. And that's why the wealthiest families in history have used it. The Rockefellers, the Rothschilds, the Stanley family, Morgan Stanley, Ray Kroc, Walt Disney. You could go on and on. As of recently, Jim Harbaugh, the University of Michigan football head coach. It's big news. Not only that, why is it that it's talked about in some of the most popular books by the most popular authors? You guys ever read this book, Second Chance, by Mr. Robert Kiyosaki? Talks all about this strategy in this book. You guys know Tony Robbins? Sure you do, right? I'm sure you do. He wrote all about this strategy in section 5.2 in his book, Money Master the Game. And then Mr. Nelson Nash, he wrote the book called Becoming Your Own Banker. Every single one of you on here today should buy and read this book ASAP. This book teaches you the foundation of banking and how you can become your own bank. And then these two books by one of my mentors, Chris Naugle, who you all know because you're here on his YouTube right now. He wrote these two books, Mapping Out the Millionaire Mystery and the Private Money Guide. These are some fantastic modern day style books about wealth building. Now, to get back to the mysteries of money though, what's the definition of money, guys? To start, what is money? Can you guys tell me? Money is. Anyone in the chat, in the comment, what is money? Come on, Shane, you've heard it a million times. What is it? There we go, brother. Knew you'd be first to it. A means of exchange. That's it. Money for food, food for money. Money for car, car for money. Money for house, house for money. Nothing more than a means of exchange, right? What about what about compound interest? What companies use compound interest? You ever thought about that before? Most people, when I bring this up, say that banks use compound interest. Wall Street uses compound interest. Who else do they say? Maybe investors use compound interest. I guess that's true. But let's focus on banks, because that's usually the most common answer. Banks don't make compound interest. They charge you compound interest, but they don't use it themselves. For example, if you wrote your name on a $20 bill, went to the bank, gave it to the teller, do you think they took that $20 bill and put it in a vault with your name on it? Probably not. That bill gets sent out immediately and goes to work for them, goes out in motion. So there isn't a business in the world that actually uses compound interest, and banks are included in that. Banks keep money in motion just like you do. You just haven't been taught how to do that yet. Next, is $1 or your dollar today worth more than in the future? Definitely not. You guys should know this too. You probably could tell me that the dollar is worth more today than in the future. Or at least it's what I hope you would say. If you don't think that's the case, think about how many candy bars you could have bought 20 years ago for $1 versus today. You probably couldn't even get a candy bar for $1. What about taxes? The taxes go up or go down? They always go up. Wouldn't you rather be paid, or wouldn't you rather pay tax on the seed versus the harvest down the road? Taxes will always go up. And if they don't, they're just going to find more crap to tax us on. And wouldn't it make more sense to pay tax on the seed versus the harvest? Of course it would. However, we don't practice that. I almost could guarantee you guys on here have a 401k or some sort of employee-sponsored retirement plan. What you're actually doing is when you give up those dollars in the 401k, you're actually giving up today's dollar, which is worth more, in exchange for weak dollars in the future. You're actually compounding the tax, because the tax is always going to be there, whether you pay it now or later, it's still there. And you're paying now tax on the harvest when it's bigger and not now on the seed. And the funny thing is, people have been taught to give up control of their money, just like I explained a second ago. But we've been taught, well, we literally have been taught to do things with money that we would never do with things that money buys. Let me give you an example. Do you guys ever go out to the store, buy a loaf of bread, drive it home and put it in the freezer, and then wait 5, 10, 20 years, and then come back to the freezer, take out the loaf of bread and start to eat it? No, right? You would never do that because the bread would be freezer burned. What about a car? Would you ever go to a car dealership, buy a car, and drive it home, park it, and then wait 10 years to drive it, 20 years to drive it? Heck no, you wouldn't. But that's exactly what we're taught to do with our money. We've been taught to give up control of our good dollars today for weaker dollars, higher tax dollars later. And if you want to be good with money, then you need to change who is in control of that money. And when I ask people about their retirement accounts, usually all they know is whether it went up or down last quarter, and whether it's high or low risk. That's about it. How is that planning or strategy? That's hope and pray. That's the hope and pray method all day long. So to truly build generational wealth, you need to challenge these strategies. You need to understand that how money really works, which is not what you've probably been taught. So let's dive into it. How does money actually work? I'll start with a question. I'll start with a little bit of quiz. Can you guys earn more money earning 4% while paying 6%? What do you guys think? Make more earning 4 while paying 6. You ever heard of this before? If you've been on our presentation before, you definitely know that you can. If you have not been on here before, this might be new news to you. I'll show you with real numbers. Let's say you wanted to buy a car for 25 grand. You also had 25 grand sitting in your savings account. And so you thought, should I take the 25 grand out and go buy the car, or leave my 25 grand in my high yield savings making me 4% and go get a loan from the bank to buy the car? What if the bank said, oh, we'll give you loan terms of 6% car loan for 60 months? Oof, I don't want to leave my 25 making 4% if I'm going to get a $25,000 loan for 6. I'm going to lose money, right? It's actually not true. Here's the math. After 60 months of paying $483 a month, you would have paid through $28,999 in monthly payments. Or sorry, total payments you would have paid throughout the 60 months. If you had $25,000 growing at 4% for 60 months, it would have grown to $30,525. You would have made $1,500 off of buying the car this way instead of buying it, paying for it cash. And two, you also still have original 25 grand growing interest the rest of your life. You never lost it. That's powerful. And the reason this is because of the depreciating interest on your car loan. Every single time you make a payment, the interest is less. And the compounding interest in your savings account growing. It's going to consistently grow each and every month. So this exercise proves to you, you can make money all day long paying 6% and earning 4%. And so this method we're going to talk about today, again, called the money multiplier method, is going to change the way you look at money in banks. We're going to talk about three things. One, a machine that you use to keep your money flowing. Two, a marathon, because it's not a sprint. Building wealth takes time. It's not a get rich quick. Anything that's good takes time. And last, we'll talk about the millionaire, everyone's favorite topic, which is just your goal. Millionaire is alliteration, so it looks cool in here, right? But it just means your goal. What do you want to accomplish? You want to be a multimillionaire? Do you want to get your time back to spend more time with your family? Do you want to be a business owner? Do you want to start your new idea? What is your goal? Because everything revolves around your goal. And so when I first learned about money and banking, this question kept popping up in my head because I was trying to figure it out. I kept thinking, could it be possible, really, that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Now, I want you guys to seriously think about that for a second. Look at the question. Internalize it. Could it be possible that there's more efficient environments to store wealth? Now, I don't think I'll ever get to a point in my life where I know everything there is to know about money and finance. Neither will you. But there are better ways we can do things. So there's always a good, better, and best. And this is a powerful question because I want you to think about what you're not already thinking about, what you haven't yet been taught to think about. And I told you guys I mentioned those money books earlier. Robert Kiyosaki's book, Money Master the Game, books like that. Have you guys all read those books? What do they teach in those books? One of the main things they teach is you should be able to save at least 10% of your income. If you don't save 10% of your income, you're never going to build wealth. That's really what they're saying. You got to put something aside. And in today's economy, the average American actually saves closer to 5%. I think it's lower than that of their income every year. It's just simply not enough. And I think in our American culture, we don't value savings. We don't value the retention of control of our dollar. And why is that? You all might have reasons. I got reasons too, but I think what it is that Americans are just so convinced that the environments we're told to put money don't really do anything. These environments like savings accounts, high yield accounts, 401ks, they're so inefficient that it's hard to save money here because the money we put in these places don't do anything. So why do we don't see growth in there? We don't want to keep putting money in there. If we don't see it, we are scared. There's risk. This is where we're told to put money. And so people don't save. That's a problem with our culture. So what we're going to talk about today is banking, how you can be your own bank. So if we're going to be doing banking and getting into that business, then what is your bank? And I should highlight, if you look up banking online, banking is the business of protecting money. So why are you in the business of protecting money with somebody else's bank, right? Well, why is that what you're doing? So what is your bank? Where are you going to store money? And the interesting thing about banking is that it affects every single component of your life. If you look up the verb form or the act of banking, it says depositing money, lending money, and protecting money. All three of those things are things you do every single day of your entire life. Why don't you do it somewhere better? Why don't you do it somewhere you can control? So what is this bank we're going to set up? If you're going to compare it to a traditional bank, let's look at the attributes that a traditional bank has. And we got to make sure we at least have those and we have more so that it is an actual efficient place to store money, right? Well, what is a traditional bank? The only attribute it has, literally the only thing, is that it's liquid. It is a liquid place to put money. Well, great. Let's make sure your bank's also liquid, right? Well, what if your bank also had growth? That'd be powerful. What if it grew at 2, 4, 6, 7%? What if that was uninterrupted growth and it was compounding interest? The average savings account in America today grows at 0.07%. We don't want that. What if that growth was also tax-free? Your banks don't grow tax-free. What if it was unprotected? Your bank's not protected right now, whether you think it is or not. Whether it's FDIC insured or not, who gives a crap? It's not protected. It's not stable. In 2009, 364 banks went bankrupt. That doesn't sound like stable or protected to me. What if your bank was protected against lawsuits, judgments, liens, in some states, bankruptcy, divorce, the market crashing? It is completely safe. What if your bank did not go bankrupt during 2008 and 9 like every other bank did? Now, that sounds like a place you could be confident in. That could be a place that you could control, you could use as a foundation to finance everything throughout your life. And I get it too. Being a business owner, you're always caught up in chaos. If you maybe not a business owner, maybe you have a family, maybe you got different responsibilities. Life's chaotic today. So the opportunity that you would actually get to put money somewhere that was still liquid, you still could use it, but it also compounded interest. It was guaranteed. It was tax-free. It was risk-free. And to add to that, what if I added that anytime you took money out of your bank, it actually didn't stop it from compounding? Wow, that's something that everyone should dive deeper into, right? Wouldn't you agree that if you had a place to store your money that did all of this, you would? What do you guys think? Would you guys store money in a place like this if there was such a place? Let's get into what this bank is. Finally, time to show you guys. I've been egging you on for 30 minutes. Let's get into what this bank actually is. And I like to call this bank a machine because it's more of a place your money runs through, right? So just like a bank, you deposit money and then lend it. It grows, it's protected, you're using it, just like banks do. So what is the machine we use? The machine we use is actually none other than a dividend-paying whole life insurance policy from a mutual company. Now, what the heck does a whole life insurance policy have to do with wealth building? You might think, oh, that's because that's what the rich and the wealthy do. It's what the elite do. And if you think, I don't believe you, Carson, it's just insurance. Okay, cool. Don't believe me. Let's look at someone else who's done this. Like I mentioned earlier, the Rockefellers on the top left. That's John Rockefeller. He did this. Walt Disney. Guess how he started Disneyland? From a whole life policy. And it's reported that these two billionaires on the bottom right have over $1 billion in cash value in their whole life policies. And these two politicians on the left, whether you like them or not, both of them incorporate this strategy in their plans. When Biden became president 4 or 5 years ago, his financial records came out and they were public. And he had, I think it was 8 whole life policies on his balance sheet. Why do you think these guys are doing it? Because it's smart. I just showed you why they're doing it. Because all the attributes that these type of accounts have. And you want to know what's crazy? The number one purchasers of these whole life policies in the world, number one, are banks. It's banks. You can look it up. BOLI, bank-owned life insurance. Just these 4 banks alone, these are all average household name banks. They all have billions of dollars in whole life insurance. And not just that, they buy more every single year. So why is that? They don't own IULs. They don't own VULs. They don't own variable life insurance. They don't own term insurance. They own whole life. Makes you wonder, right? And if they're buying more and more every year, you have to ask yourself, are banks stupid or do they know something that I don't know? Guys, they know what they're doing. They're smarter than I am, smarter than you are. We just need to mimic them. So that's what we're going to do, is mimic what banks do.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So I'll show you what banks do on a day-to-day basis. If you had $100,000 and you deposited it in a bank, and let's say your bank was awesome, they paid you 4%, and this $100,000 number can do whatever you want. It could be 10 grand, it could be $1. Just say you're earning 4% at a cool savings account. What does the bank do the second you deposit the money in? They lend it out, like I told you earlier. So they lend it out. So let's say they take that money and lend it to somebody buying a house at 7%. Well, what's going to happen when the house sells? Well, we're going to pay the seller. Who's going to put the money back, right back in the bank? Well, what if the bank then wants to lend it out again? Well, of course they will. They'll lend it to somebody buying a car at 8%, who will pay the car dealership upon closing. Who will put the money where, right? Who will lend the money back out to somebody doing a home remodel loan at 9%. And then they'll probably pay their contractor to do the job. And then where's the contractor going to put his money? Back in, right? Duh. What if the contractor had a debt consolidation loan he wanted to pay off? Going to go pay off his credit cards? And where do the credit card companies put the money? Back in the freaking bank, guys. Who's in control of all these transactions? Not you. Not me. The bank, not the car dealership, not the contractor, not the credit card company. While you're making 4%, they're making 7%. They're making a 3% spread. While you're making 4%, they're making 8%. They're making a 4% spread. While you're making 4%, they're making 9%. They're making a 5% spread, and they're making an 8% spread on this loan. In this specific example I'm sharing with you, while you were earning 4%, they were making all of these spreads on you. And I just spoiled it, but if you are making 20% more than I am, 20% on my 4%, 4 goes into 20 5 times. That means they're making not just 16% more than you, but they're making 500% more than you are on your money each and every year. If you go to BauerFinancial.com, you will read that banks make between 400 and 1,300% on the money that you leave there every single year. So earlier when I told you guys that these banks are the #1 purchasers of these whole life policies, the thing I asked you was, are banks stupid or do they know something you don't know? Guys, they're not stupid. We're stupid for giving them the money. They know something we don't know. And not only that, banks understand statistics. They understand how math works. So of course, they're going to be using these strategies. Of course, they're going to use whole life insurance. So that all being said, I'm going to get into some examples here. We have about another 20, 30 minutes. I'm going to share some real life examples, some numbers, showing you how to buy a car and pay yourself back through your own bank, through a policy. In other words, if you haven't caught on. And some examples of paying off debts, maybe making some investments. I'm going to show you some real numbers here. So before I get to these numbers, anybody on here have any questions they want me to hit further about anything I've discussed? Anything at all before I dive into some more numbers and we take this a different direction? I'll give it a second here. I noticed there was a couple hand raisings as well, so maybe you guys had questions at some point. Is there a downside? Yes, there is. We will get to that in a little bit. Good question. Okay, all right, well, you know what? If there's not too many questions now, here's what we'll do. I'll go through all these examples, share some more numbers so you can see more what I'm talking about, maybe deepen your understanding a little further. And then we'll do questions again at the end, and I'm sure then you'll have more. So here's an example of a policy. Now, don't look too deep into this. I'm going to explain every single number in 2 seconds. Okay, just give me a second. So I want to talk about a couple of things first. When you put money in a life insurance policy, and to answer your question, Grace, how they make compound interest, I'll hit this in a second. When you put money in a life insurance policy, you are paying a premium, right? Most of the time, when you hear the word premium, you think it's a bill. Home insurance premium, health insurance premium, car insurance premium. Premium's bad, right? Well, we need to change that mindset. Because when you think about it, when you go to the bank and you deposit money in a bank account, that money sits there and it's liquid. And I've never met any person that doesn't want to deposit more money in their bank account, right? Well, what if the policy was the same? Every time you deposited money into it, it was liquid and available for you to use. Well, then why wouldn't you want to deposit as much as you possibly could into it, right? So your premiums are just really your deposit. That's how you're storing money inside the policy. And every time you pay into the policy, you are buying a death benefit. This is life insurance. But the way we design the policies, we're designing the policy for more cash value, more liquidity, and less of a death benefit. We're maximizing what's available and minimizing the death benefit cost. That way, everything you have going into it really is going to you. And then as you pay into the policy, you earn a dividend and interest. The insurance company will pay you every single year dividends, and it grows every single year of your life compounding. That's where the interest comes into play. And some people might be thinking, oh, I might be too old to do this. I can't get life insurance. I've heard people tell me this when they were like 45. It's crazy to me. You are not too old to do this. Age does not matter at all. Because think about it. If I put $1 in my savings account and my grandma put $1 in her savings account, it's still a stupid dollar. Age doesn't matter. It's still $1. So if we're putting $1 into a policy or she's putting $1 into a policy, it's still $1 that she has access to. So the use of this being a bank, a savings vehicle, a place to store money, there's no difference. Sure, maybe she'd have a lower death benefit than I would for that same dollar, but we're not doing this for a death benefit anyways. We're doing this policy for the banking attributes that it offers us. And yes, there's a death benefit, but we actually don't really care. I mean, the death benefit's important. I want you to have coverage to protect your family, of course. But I'm not building this policy to give you the biggest death benefit possible. I'm building this policy to give you the banking opportunities in your life. So now that you understand how these policies are designed and kind of how we look at it, here is some examples that I can share with you. So back to the point of wanting to buy a car and pay yourself back for buying this car, making all the money back on the car that you purchase, in other words. Well, in the scenario, I'll give you an example. This individual was saving 10 grand a year. That was about 800 bucks a month. So super stoked for them, right? They're saving 800 bucks a month. Awesome. They chose to save their money inside of a policy instead of a traditional savings account. And guess what? When they made those deposits into the policy, the insurance company gave them cash value. Cash value is what's liquid and available for them to use. If you take cash value out of your policy, it's actually a loan. You're taking a loan from the insurance company against your policy. It's a loan against your policy that whenever you take money out. While you take a loan out of your policy, your money continues to grow inside of it. That's why I said in the beginning, you can take money out and still grow. You're growing inside the policy and taking loans against it while it grows. So because of that, when we look at this, the cash value in year number 1 is $5,800. In year number 2, it's $12,000. Year number 3, it drops to $4 grand. The reason it drops to $4 grand is because I want to show you an example of taking $25,000 out of the policy and buying a car. So he's put in 30 grand up to this point, taken out 25 from the cash value to go buy a car cash. Then he's going to pay himself back. If you take a loan from yourself for 25 grand, shouldn't you pay yourself back? Heck yeah, you should. You wouldn't not pay somebody else back. So $500 a month would be the repayment for 60 months. That was about what the number was when we did the math earlier, right? So 500 bucks a month for 60 months, he repaid himself for the car. So you do the math. He's put in 70 grand in premiums. He's put in 30 grand to repay his car loan, and that's $100,000. So he's put 100 grand into this thing over 7 years. That's a lot of money. He also took out 25 to physically buy the car. So he really only put into the car 75,000. So he's put in 75, and look at his cash value. I didn't underline it, but in the 7th year, his cash value is $67,881. So he put in 75, and he had access to 67 and had a car fully paid for in his driveway. So in all reality, he only spent, well, if he has access to 91 cents on the dollar of what he's put into it, and he has the car, then didn't he get 91 cents back on the car he just purchased? I'll go further with this example so it clicks better. Let's say he does it again. In the 8th year, he stops paying premiums. No more deposits into the policy after the 8th year. But he needs to buy another car. So he takes another $25,000 loan from his policy. He repays himself 500 bucks a month, just like anybody else would. And now during those new 5 years, year 8 to 12, he did pay 30 grand in loan repayments, but nothing in premium. He also took out a $25,000 loan to repay himself, right? So he put in 5 grand basically, and look at how much the cash value increased by, 67 to 91. The cash value grew by $23,000, and he put in just 5. So he just made money off of buying the car. And if you look at the entire 12-year period, let's do the math. He put in $75,000 in the first 7 years. He put in $5,000 in the next 5-year period. So he put in 80 grand over these 12 years. His cash value is 91 after 12 years. He put in 80, has 2 cars, and has 91 in his cash value left over. He made $11 off of buying the car. I guess both cars. Does that make sense? I'm hoping it does. There's 3 rules we use when we do this. Okay, rule number 1 is pay yourself first. If you're not going to save money, you're not going to pay yourself first, put it into your bank first, then there's no use of doing anything in your financial life. You got to pay yourself first. Rule number 2 is if you take a loan from yourself, pay yourself back with interest. Don't steal from yourself. And rule number 3 is you want to recycle and recapture that interest that you were paying. Wouldn't you rather pay yourself the interest than paying somebody else? Right? And so if this works for a car, what else does this work for? Everything and anything. So guys, don't you wish that you did this last time you bought a car? Don't you wish you guys did this last time you bought a house? Maybe paid Uncle Sam? Don't you wish you taught your children how to do this? Who's going to use this the next time they buy something, right? This works for everything we do in our life. So as I share one more example and scenario for you, I want to show you what it's like to pay off debt through a policy. I'm not sure if you guys have any debt, but most people in America do. And most people have a very similar situation to this guy. This is a case study we did a few years back. This guy had some credit cards, a car loan, a boat loan, a house, a condo loan, and these were all of it. He had 500 grand in debt pretty much. Now, this guy made good money. That's why he had all these extra toys. He was a chiropractor, and he actually saved about 25 grand a year on top of these debt payments. He was just throwing an extra 2 grand a month at his debts to try and chunk them down. And it was working slow and steady, right? But there was a better way he could do it. He had this extra money, so he needed to use this extra money to help pay down his debt more efficiently. And so what his current debts looked like was $5,700 a month. 500 grand is a balance. It was going to take him 19 years to pay everything off. That's pretty hefty, right? We don't want to wait 19 years to pay off our debt. So we looked at it and said, all right, well, let's just strategically pay this down. Let's snowball it. Let's snowball your debt, but do it through a policy. So instead of paying all your extra money onto the debt first, pay all of your extra money into your policy. Use your policy as your savings vehicle. Angel, I see you said you need to hop off. You're heading into an appointment. If you'd like to head out, please email me here at carson@chrisnaugle.com, and I will send you the recording. You can watch this later, finish it up. If you would like to meet and have a free consultation to learn how this strategy works, you also can email me, or you want more resources or books, I can send you more information as well. Thanks for mentioning that, Angel. So back to this scenario. This individual had $5,700 of debt every single month that they were paying. And they saved 2 grand a month, which is about 25 grand a year. So we said, all right, well, how about instead of you paying 25 grand a year extra on your debts, let's put that in the policy. So 25 grand goes into the policy. Year number one, he takes out $14,000 of cash value. That's what was available for him to use. So he takes $14,000 out, pays down his first 2 debts. Gone, a little bit of endorsement cards, gone. He paid those 2 debts off, and guess what? Now he no longer has to pay $161 a month for the Discover card and $287 a month for the Lowe's card. If he doesn't have to make those payments anymore, now what? Well, those of you listening should know he gets to now repay himself. Hooray! Right? He now only has to pay $5,300 a month on his debts, and he can pay himself back $448. So now, guess what? He's doing 25 grand again in year number 2. He puts into the policy. His cash value available in year number 2 is 16 grand. Woo, he has access to more than the first year, right? Well, it's because he's growing in it. And then he paid himself back $448 a month, which is about $5,300 for the year. So he put in, or I guess he has access to $21,900 in the second year. 16 in his cash value, 5 that he repaid himself throughout the year. He's going to use that 21 and go pay off these next 3 debts and some of the BMW, which frees up a lot of monthly payments he no longer has to make. Now he's only paying $3,800 a month in payments and can save $1,900 a month and repay himself $1,900 a month. Third year goes, 25 grand goes in again. He has access to 25 in his policy. He repaid himself $1,900 a month, so that's 23 grand. He had 48 grand in this third year now to use to pay down his debts. He paid both of these things off, and we're 3 years in, and he's debt-free except his house and condo, saving an additional $3,600 a month. So by snowballing his debts and running it through a policy so that his policy was growing while he was doing this, he's now not just paying off his debt faster, but he's also building himself wealth long-term, because all of his money that he's putting in policy will now sit and then grow the rest of his life. Now, let's sum this up. How much have we put in over the first 3 years? 25 grand, 25 grand, 25 grand. How much have we taken out? 14, 16, and then 25. So you've put in 75 and taken out 55. So what does that mean? That means we should have 20 grand in our policy, right? Wrong. Remember that we're borrowing money out. It's a loan. I said it right there. I gave you the hint. We've put that money in, and it's going to grow and earn interest forever. That 75% or 75 grand is going to compound interest the rest of your life. And then we're going to take loans against it to use our money to pay stuff off. So let's keep going. You guys know how this works now. He puts 25 grand in. He has access to 26 in his cash value in his policy. He also repaid himself $3,600 a month, so that's 44 grand. He has access to 70,000 in this next year to use, so he does it again, pays down his condo, almost paid off now. Following year, same thing, pays off the condo, some of the house. Again, 6th year, he does it, pays off his house, and he is debt-free. So he's debt-free after 6 years instead of 19. Huge difference. So I'm going to get to this slide here. All right, so what if you don't have any bad debt? Some people come in and ask that. What if they don't have debt? What if I don't need to buy a car? Can I still benefit from privatized banking? Can I still do this? Should I still do this? Should I become my own banker? Heck yes, you should. Of course. I don't have bad debt. I don't need to buy a car right now. What am I using it for? I'm using it for the fun stuff. I'm buying rental properties. I'm lending money out. I'm investing in syndications. My money's going out and working for me. That's way more fun than paying off debt. So after debt's paid off, after your personal needs are taken care of, now we're going to go invest and grow this thing. This is where the legacy comes into play. So let's continue back to that old example. Let's say that after this guy paid off his house and his condo, they're paid off, they're gone. He chose to repay himself what he would have paid the banks. He was paying $870 and $9 a month for his condo and $1,200 a month for his house. Over the rest of those loans, he would have paid $493,000 back to the banks over that 30-year period to pay for the houses in full. But by using this strategy, he paid off his debts faster and paid himself back these amounts. He paid himself back $500,000 over the next 30 years. That's money he put back in his pocket instead of somebody else's. So guys, this strategy, if you think you're just going to get a policy in life solved, wrong. The policy is not solving your problems. It's how you use the policy that will. It's how you become the bank that will. It's financing things yourself and repaying yourself that will. That's the benefit. So this strategy will be used most efficiently when you are using your policy. And now that you guys know this, everybody you know should know this too. And if you don't, you're stealing from your family. There's so much money you're leaving on the table by just spending it all that you could save and grow with. It doesn't matter whether you make $10 an hour or $10,000 an hour, guys. It doesn't. I see broke people and rich people in both places. As long as you can save money, you're in a good spot. This can work for pretty much anybody. And think about it. The wealthy do this for a reason. It's because they know what it can do and they understand how to keep their money in their families. So we need to break these bonds of financial slavery we've been taught to be a part of. We need to continue to pay off debt. We need to continue to build a successful savings system to build generational wealth. And that's what the 95% don't do. This is the 5% kind of stuff. When you do this, you are setting yourself up for success, and not just yourself, but your family, your kids. So to wrap up, I want to share with you guys a couple additional facts just so you can get some other perspective here. Policy grows tax-free. I think I kind of hit that already though. The death benefit in the policy is also tax-free. These policies are safe from judgments and liens. You could use this cash value in your policy for tax-free retirement income as well. On top of all this, you could use policies to help with your kids' schooling, maybe businesses in the future, and other things you might need to do. How do you fund your policy? You can fund it at whatever frequency you want, guys. You can put money into it every month, every quarter, once a year, however you want. And some people ask, what's the minimum that you need to put into the policy to make this worth it for you? Well, it's a very common answer, or common question. The answer is 10 times your age monthly. Kind of a weird formula, right? Say you're 30 years old, $300 a month is the minimum we'd recommend to put into this. Say you're 50, $500 a month is the minimum we recommend to put into this. If you're not in a position to save this, you're not ready to do this strategy yet. You need to go find ways to make more money or save more money. Once you are, that's the minimum. The maximum depends on you, your net worth, your assets, your business. Those kind of things would highly affect how much you can put into a policy. We've seen people put millions of dollars into it though. And on top of a premium deposit, you can do a large lump sum to start the policy. So if you do $500 a month, you also can dump in any money you have sitting in these different accounts. You get 10 grand in this account, 20 grand in an old 401k, 10 in this, dump it all into the policy, get it all kickstarted, and now you have money to work with. And you'll have access to 60 to 90% of what you put into the policy right away. So to talk about policy loans as well, when you take loans from your policy, I want you to know they're guaranteed. You are guaranteed to have access to them whenever you want. The policy loans are based off of how much money you've put into it. So you have access to what you've put in. And there's no credit checks or approvals when you take a loan. You ask for the money, they send you the money. And these loans are private. They're not on your credit report, so you now can pay off a debt through a policy, and now it's off your credit report and you're paying yourself back. And there's no minimums or maximums to how you pay your policy back. If you miss a payment, nothing happens. You are in complete control of how you repay yourself. And people ask me, well, Carson, why work with you guys? Well, first off, I teach this strategy because I implement it myself. Everyone on our team does the same. We get paid from insurance companies. We're paid from them for the business that we bring them. And so we're taken care of already. All you need to do is just fund your policy and use your policy. We're going to do the rest. We'll help you. We'll help you set it up. We'll help you strategize how to use it. And we'll give you a plan to work off of. and then you can go off on your own and do your thing. We're not going to charge you to help you set this up or charge you to have an ongoing service to be here as a guidance for you. And so there's no barrier to entry with this. As long as you can save money, you should be implementing this. You should be doing this. And we have an entire team set up here to help you do this. And between all of us, we've helped over 20,000 families across the country learn this strategy. And so you know what I'll add to this? I'll just say that there's only one of two things that are going to happen to us in our life. All of us are going to live. We all are alive, right? And we are better off with this than without. I just showed you many reasons why. And what if you passed away? What if something crazy happens to you tomorrow? Guess what? Your family is way better off with this than without. They have something to fall back on. If you didn't have a policy, they'd have nothing. So the strategy is not just meant for you, but it's meant for your family in case of emergencies. You guys all know this man. He says that if rich people or poor people would just do what rich people did, they wouldn't be poor anymore. Guys, I love this guy. Warren Buffett's a great example. Guess what company he owns? He owns a lot of companies, but guess what one of them is? An insurance company. I wonder why he owns that, because he knows how profitable it is. He knows how smart it is. So if you guys would just do what rich people would do, you wouldn't be poor anymore. How many of you guys could see yourselves doing this, guys, in the chat? What do you think? Now, I'm going to give you guys an opportunity here to learn this and get a specialized plan for you for free. Again, everything we do is free. So I throw that in there, but it's not really anything special. If you guys want to take control of your financial future and you want to have this certainty and this type of asset in your life, you'd absolutely need a banking policy. So you can email me at carson@chrisnaugle.com to get to get whatever you want, questions answered. If you have quick questions, you want to email me. If you want to go through your specific scenario and schedule time to meet with me, you're welcome to do so. If you want to schedule time to meet with me now, you can just look on that calendar link, carson.beyyourownbanker.com. You can go there, schedule time to meet with me, and we can figure out how you can incorporate this strategy as well. Now I'm going to wrap up here with about 5 minutes, 10 minutes of questions and answers in case you guys have anything you want to talk about. I'm here to help, but I'll keep these links up. If you want to, again, email me and want more resources, have specific questions, let me know. If you want to meet and learn how you can incorporate this strategy as well, go to carson.beyyourownbanker.com and you can find time to meet with me this week. All right, some questions. The Whipples, you asked if you can call me today. Yes, you can. Go ahead. I'm here to help. You asked that in the beginning, so sorry I didn't get to that till just now. Jeremiah said, what interest rate could you expect to accrue on one of these whole life policies? So like I said earlier, you earn a dividend. And basically what that means is when you get a policy with a mutually owned insurance company, you are a mutual owner of the insurance company. You are a part owner. So every year that the insurance company is profitable, they have extra income. What do they do with their extra income? Well, like every business, they pay their owners. That's you. So every year your policy grows as the insurance company is profitable. And we're working with companies that are extremely strong, companies that have been around for 100 years or more, A-rated or higher, and that they have paid dividends every year they've been in business. So those are the companies you're dealing with, strong companies. Historically, over these 100, 200-year periods of these insurance companies being around, their dividends on a historical average have been about 7-8% a year. In the 90s, they were in the teens. As of last year, they were around 5-6%. So it changes every year as based on how profitable they are. But that's the interest you're earning and the compounding inside of the policy. Question from Grace, can my first dump in be anytime after I start my policy? Say I start my policy with whatever, X amount per month, but then I have a large amount I want to put into it later on. Can I? Yes and no. If you are knowing when that money was coming in, you knew exactly how much, we could design the policy to allow you to slip it in, but we would just need to know up front. So yes, it's an option, but it needs to be planned out, if that makes sense. Downside from, sorry, I missed your question earlier, Jeanette. What's the downside to doing this strategy? Well, look, the product of whole life insurance, there is literally zero risk. Literally, no risk. The policy is never going to go down. The cost of insurance will never go up. Everything gets better over time, no matter what. It's literally guaranteed in the contract. So there's no risk, but the risk is how you use it. If you take loans from your policy and blow it and have a loan you need to repay and don't have the money to do it, and you lose your job, well, you're going to lose the whole thing. It's going to blow up. So if you just make smart investment decisions, you use your cash value wisely, you pay yourself back, then no, there's no risk. There's no downside. It will work perfect. So the risk is you, how you use it. And yes, you can start a policy with the large lumps. You could put 200 grand to start the policy, $1 million, whatever you want. You can put money into the policy to get it started. But it does depend on your premium and how we design it and your income and if you qualify for it and that kind of thing. But that's the kind of stuff we go over personally, depending on your situation. And I see your last question here, qualifications. I mean, you have to qualify for life insurance. So, I mean, you got to be relatively healthy. You can't have any recent criminal history or bankruptcies or health scares. I mean, just regular life insurance qualifications. So if you can qualify for life insurance, then you're fine. Is there an investment, Christian, if you have small amount of money, if you have no debt? Is there an investment so are you saying, hey, I paid off all my debt, I have money to save, I want to invest it somewhere. What's the minimum amount I typically need to invest? If that's your question, honestly, man, I don't know. It depends on what you want to invest in. There's millions of investments out there. If you want to invest in real estate and lend or something like that, you probably need 25 to 50 grand to do some sort of investing in terms of lending money out to people. But if you want to invest in a stock, you can put $1 into a stock today. If you want to buy crypto, go for it. You need $1 to do it. So, I mean, depends on what you want to invest in. I asked one of my life insurance agents about infinite banking. And he told me it was a scam. I'm going to share this with him. Awesome, Jeremiah, please do. It is most definitely not a scam. I'll tell you though, it can sound very markety. If you look on Instagram or TikTok and you hear somebody say, be your own bank, use life insurance, you can get all these crazy returns. I mean, they're pushing it. They're definitely a little more aggressive than what it probably truthfully is, but it's not a scam. Infinite banking is a fantastic strategy you can use to save money more efficiently and pay stuff off more efficiently, invest in things more efficiently. So it works. And honestly, all you're doing is changing one thing. And it's just where you save your money. You're saving money instead of a life insurance policy, instead of a savings account. It's literally all you're doing, no difference. So it's not a scam. Question here, why not use an IUL or a variable universal life or any equity universal life or any type of other type of life insurance policy versus whole life? Great question. Remember at the beginning, the attributes of a policy: guaranteed, tax-free growth, consistency, costs staying the same. You don't get any of that with a variable policy. In an IUL, basically what you're doing is you're putting money with an insurance company, they're investing it in stock options, and then they're buying term insurance on an annual basis. That's the chassis of the product as well. So you're buying annual renewable term insurance, which the older you get, the more expensive it becomes. And then you're investing in stock options in the market. Market does bad, you get nothing. Great, there's a floor. If it does good, you're capped. You only can gain 9-10%. It caps you at the growth. And so there's no consistency. It's volatile to the market. And if you take maximum loans from your policy and you don't repay them and the market goes down in a year, you'll lose the policy just like that, because the cost of insurance will rise. You'll have nothing in there to pay it. So the cost of, or the risk of the policy is too high. If I'm going to use a policy to buy a car for my child or prepare for student payments or tuition in the future or invest in a rental property, I don't want risk. The policy doesn't, I don't want risk. My risk is in the investment I'm doing. I'm buying those investments because I know the risk I'm taking on and I can control it. I cannot control an IUL. IULs typically blow up on themselves every single time. It's guaranteed in the contract for it to blow up when you're in your 60s, 70s, 80s. So why would I buy a product that I know is going to go to zero when I'm in my retirement years, just for maybe higher returns than a whole life, but way more risk? If you're comparing an IUL to investing in the stock market, sure, maybe an IUL is better because then you also get insurance, but you can't compare an IUL to a whole life because they're two different products used for different things. And last question, can I roll money from a self-directed Roth under my LLC into a whole life policy? If money is in a qualified plan, you can't take it out of a qualified plan without paying taxes and penalties. If it's a Roth, no taxes, but you'll still owe a penalty. Unless you're over 59.5, then there's no penalty. So if you're over 59.5, sure, pull it out, dump it into a policy. If you're not, you will owe penalties on it and tax if it's a 401k. But you can move money out of those retirement accounts and move it into a policy. It does make sense. Not every time. Depends on the scenario. All right, guys, great questions. Again, if you do want to meet to learn about this strategy further, please schedule time on my calendar. And there it again is. I think, Grace, yep, no questions. All right, we're good to go, guys. Enjoy your week. Next week, we will be doing the same presentation every Tuesday. Tomorrow, we have plenty of webinars talking about real estate, wealth building, other tax tools, all tomorrow, all day long on Chris's YouTube live. Attend those if you can. Grateful to have you guys on here today. Enjoy your week.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.